Welcome back to The Explainer, folks. I'm Steve, and today, man, we are cutting straight through this so-called peace deal euphoria you're seeing plastered all over the mainstream media. If you've been watching the news, you'd think all the world's geopolitical problems were just magically solved by one little piece of paper. But the tape doesn't lie. And the real pros out there, they are positioning for a totally different reality. So let's dive right into the ledger.
Just let that massive number sink in for a second. $397 billion. We're not talking about the GDP of a small country here. This is the all-time record-breaking cash pile currently sitting at Berkshire Hathaway. Now you gotta ask yourself, why? The smartest professional money in the world is hoarding cash. They are literally building a fortress. When you see war chests getting this incredibly deep while the markets are floating up near all-time highs, you better pay attention. Today we're gonna look at exactly why they're stockpiling this cash and what it actually means for your portfolio.
All right, here's our docket for the afternoon. 1. The closing tape. 2. The Berkshire warning. 3. The geopolitical reality. 4. Bull versus bear scenarios. And finally, 5. The trading directive.
Starting us off, Section 1, the closing tape. Let's get into the hard, indisputable facts of Thursday's 4 o'clock close. The bears were prowling for a follow-through today, and late in the session, they absolutely got it. This brilliantly illustrates exactly what happens when the peace trade narrative slams face first into a brick wall of serious institutional skepticism. Look at the board with me. The U.S. stock market slipped from its record highs. The S&P 500 finished at 7,337.11, closing down almost 0.5% as investors woke up to the fact that a memorandum is not a treaty. Then you've got Brent crude dropping below the $100 mark for the first time this week, settling at $99.87. Gold tagged a massive 2-week high before profit-taking dragged it back down to a flat 4,700 at the bell. That wild intraday swing tells you just how volatile sentiment really is right now. And Bitcoin snapped its win streak hard, bleeding out over $1,600 to settle at $80,117. Listen to me on this. When safe havens whip around like that and risk assets bleed out at the exact same time, the market is hesitating, and it's doing it for a very good reason.
Which brings us to Section 2, the Berkshire warning.
Now, for anyone getting a little dizzy buying up at 7,300 on the S&P, you really need to take a hard look at Omaha's red folder warnings. This shows us exactly how the big boys, the smartest professional money, are positioning themselves. Greg Gable just released the first Q1 report of the post-Buffett era, and man, the contrast here is staggering. Over on the left, you've got the cash fortress, that record $397 billion in dry powder, and on the right, the exit strategy. Berkshire was a net seller of $8.1 billion in stocks this quarter, so the takeaway is crucial. Abel and his team are absolutely not buying this tech-heavy squeeze. No way. They are perfectly happy sitting on nearly $400 billion, just waiting for the market sentiment to crack and the real snap to happen.
And let me tell you, they have solid macro reasons to be sitting on their hands. Check out this secondary macro signal that hit at 8:30 a.m. today. Initial jobless claims came in at 205,000, while non-farm productivity just absolutely cratered to 0.7%. Guys, this right here is a massive red flashing light. If productivity is stalling out, but wages are staying sticky, well, the Federal Reserve's job just got a whole lot harder. Companies are basically paying the same or even more for less output. It is a completely toxic cocktail for corporate margins. And you know the drill. When margins compress, earnings multiples have to adjust. It's exactly this kind of fundamental friction that justifies holding massive cash reserves right now.
Moving on to Section 3, the geopolitical reality. We need to step away from the financial tape for a second and look at the harsh physical reality going down right now in the Strait of Hormuz. Social media wants you to believe it's a total resolution, but the actual data tells a completely different story. First off, while Iran is claiming to review the U.S. peace proposal, they literally just set up a brand new government agency designed specifically to control and tax every single vessel passing through the strait. Honestly, does that sound like the behavior of a country getting ready to sign a lasting peace treaty? Didn't think so. Second, that 48-hour window for Tehran to sign that one-page memorandum is closing fast. And the threat to take out Iran's domestic power grid is still sitting right there on the table as the ultimate poker chip. Finally, look at the maritime insurance firms. They are still flat-out refusing to cover hulls. Insurance guys deal in hard risk, not hope, and right now, a single sheet of paper doesn't magically sweep a minefield.
All right, Section 4, Bull versus bear scenarios. With all this heavy geopolitical weight hanging over us, tomorrow's opening bell is going to be dictated entirely by how this showdown plays out over the next 12 hours. Here is the setup. On the left, we've got the mainstream dream, the peace dividend. The bulls are betting this one-page deal is a masterstroke. The blockade breaks, the S&P rips to a locked 7,500, and oil crashes back down to the $80 handle. But over on the right, you have the veteran reality, the ultimatum trap. This is the bet that the new shipping tax is a clear rejection of the peace deal. Listen, if the bombing resumes tomorrow, buying oil at $99 today was an absolute gift. We would be staring down the barrel of $150 Brent crude and a violent, aggressive test of the 50-day moving average on the S&P. These are massive, binary outcomes, and the market is absolutely pricing in the tension.
Which brings us to the actionable phase of our explainer. Section 5, the trading directive.
So how exactly do we trade this beast? I'm going to give you the defensive trading levels for tomorrow's session. Look closely at this chart of the S&P 500. You see that gap between the current price up around 7,410 and that aqua blue line? That is the 20-day simple moving average. We are hovering dangerously high in absolute nosebleed territory right now, massively overextended and running on pure fumes. If we gap down below 7,300 tomorrow, make no mistake, the relief rally is completely dead and the trap is officially set. You do not want to be caught holding the bag if that aqua line acts like a magnet. The downside vacuum here is substantial.
Next up, keep your eyes glued to the energy pits. Brent crude is easing just below the $100 mark right now. The absolute critical level you've got to watch tomorrow is that $95 support line. If Brent stays above $95, it tells us the real professionals simply aren't buying the mainstream peace story. They are pricing in the hard, physical risk that those ships are not going to be moving freely anytime soon. If that 95 level holds firm, it acts as a crystal clear indicator that energy traders expect the geopolitical premium to stay baked right into the price.
And we actually have confirmation of that exact fear right here. The action we saw today in gold is a vital tell. Pushing up to a monthly high and closing firm at 4,700 confirms that major players, the big institutions, are still heavily hedged against a worst-case scenario. They are holding their safe haven positions incredibly tight. The fact that they aren't liquidating their protection means they absolutely do not believe the all-clear siren has been sounded.
Okay, so here are your strict, no-nonsense directives for the coming session. Number 1, ignore the noise. The headlines are just designed to create liquidity for the big players to exit. Number 2, trade small sizes. In volatile, binary geopolitical setups like the one we're in, capital preservation is job number 1. Number 3, use tight stops. And number 4, watch your averages. If those moving averages snap, do not, I repeat, do not try to catch a falling knife. The market doesn't wait for latecomers, and it certainly doesn't care about your feelings. Stay disciplined.
I'm going to leave you with this stark reality to chew on tonight. If the Oracle and the smartest institutional money in the entire room are comfortably sitting on $397 billion in pure cash, just waiting for the dust to settle, why are you fully leveraged heading into tomorrow's bell? Seriously, rethink your exposure to the hype. Protect your capital. This is Steve. The ledger is open, and I will see you at the bell.